Welcome. Thanks for joining us today for the highlights of the much anticipated March planning intentions and stocks report. Although for once, the trade kind of had it pegged on what we were going to be seeing in the numbers a little bit. Joined by Brian and Michael today to kind of digest the report. So let's dive into it. Michael, starting with you.
Yep.
Corn planting intentions. What everybody was focused on a little bit.
Yep.
A little bit above expectations, but I'd argue probably more in line with, I think, where the trade was at. There was a lot of estimates, a lot of anticipation around that 95 plus or minus.
Right.
Where did we come in at? How does that compare to last year? And kind of going forward, what does that maybe do to the balance sheet?
Yep. 95.3 million acres is where we came in today. You're right. Average trade guess was 94.4. So definitely a little higher, but it did seem like a lot of private estimates based on private surveys from a handful of people. We're creeping up to 95 plus 90. We saw some 96, saw as high as 97 on an internal balance sheet. It feels lofty, but USDA did confirm that there's a lot of corn that's going to go out there. And if you look at the corn bean ratio, literally since last fall, it felt like we were going to get a lot more corn acres. Now we're getting a little confirmation of it, even though most planters haven't started rolling just yet. So it's a big number, up over 5% year on year. I think it's the highest since 2013. A lot of corn expected to go in the ground. From a balance sheet standpoint, we have to prove it out. Weather's going to obviously matter in the cadence of planning. But as of right now, there's really no reason to think that it's not achievable. What I would say looking forward, if you think about the USDA's forum, though, they had the yield pegged at 183 on the go forward. So the more acres you add, I would argue the harder it's going to be to achieve that. We had essentially a perfect growing season last year, and we couldn't quite breach that number. If you're going to go add, 4 to 5 million acres more, you're creeping further into the fringes, i.e. maybe less productive ground. It just becomes a taller task, I guess.
Still gives a pretty good cushion though for that.
Sure does.
I think even throwing in on our balance sheet, looking at it now, maybe a 181. Even in that 179, 180 range, we're still over a 2 billion bushel carryout.
Right.
So at least the intentions there on paper, we're going to be trading this and for a while here. We'll get into the stocks number, maybe what that implies to our current balance sheet here a little bit, but overall a comfortable acreage number. Probably had the trade already, like you said, with the bean corn ratio. Probably had the trade already a little bit on the short corn side, long soybeans, and a little bit of unwinding, considering above average trade guess and the market closing a little bit positive, unchanged for new crop corn. So didn't quite get the sell off that maybe a 95.3 million acre number would imply or would have implied in the past. So we're still watching a lot of moving pieces on the global balance sheet, Brazil weather, et cetera. So it's
probably worth mentioning too, though, that we were above a 2 billion last summer for expectations for last fall, right? We were 2.3, 2.4 at times, and obviously demand pacing this fall changed a lot of that. And so we're at the carryout we are this year, operating 800 to 900 million less than what was expected last summer. So we got to kind of keep all of that in mind too.
Right. Got to prove it out.
Got to prove it. Yep.
But overall, a comfortable acreage outlook, a little bit of above expectations. And so kind of shifting then to the bean side, where we expected that to be a lower number, where that came in at, and maybe a little bit of digesting how we go forward with still some expansion in our domestic soybean crush build outs, especially in that Western belt. I think over this last year in farmer meetings I've been doing, there's a common theme among producers, especially when you get west of the Mississippi, where a lot of that soybean crop had a kind of a captive front end marketing year demand when our exports were strong. And then as we see Brazil come online, it starts to shift, and their basis impacts in that Western corn belt were pretty significant from when that export demand existed to when it became back to a domestic flow. It's a little bit more favorable for them. So I think that, in my conversations, again, the Western producer is very aware of their continued domestic demand in beans. So maybe a surprise to see some of those acres shift back to corn, even though the economics are favorable.
Right.
Leave some unknowns going forward.
Yeah.
Right?
Yep.
So what did we see on the beans?
83.5 million on beans. Pretty dead on with expectations. Market was looking for 83.8. not a huge change. I mean, last year we were at 87.1, so it's a healthy drop. You know,
Right.
we lose bean acres, we lose wheat acres in lieu of this big uptick in corn that we saw, right? So there's a pretty clean shift as far as that goes. It still matters though. You know, the bean acres are down 4% year on year compared to what we had last year. I think it's a 5-year low for U.S. bean acres. But again, going forward, there's a lot of other things at play here. You know, we have corn is favorable economics. We got, you know, an acreage trim that might not be enough to offset what feels like a pretty hefty supply tone when you take in South America and the massive increase in competition that we've seen. So we have a nice uptick in soybean demand, as you pointed out, you know, especially in the Western Corn Belt, more crushers coming online. We've been bleeding export demand to the Southern Hemisphere for good reasons. They're growing bigger and bigger crops. So all of that plays a role in this too.
Right. That's a point that is worth noting, right? With the South American crop and the harvest pace and at what we feel like the crop size is, which we'll get some updates on that. But overall, the Brazil crop,
it's huge
year over year increase. So we can afford to have a smaller carry out potentially, because on paper, you know, we're talking about with the USDA number today at 83.5, and again on paper 52.5 yield, ending stocks to use below 7%. So, you know, a couple percentage points below the last 2 years, kind of back to where we were at in that 22 marketing year, front end of 23. And ultimately, it could feel tighter on paper, but we got to take into account that we might be losing more and more export share as we roll forward, especially if there's another big crop coming in Brazil. So what our current production outlook is for new crop might have a little bit of cushion even at the acres total that we're seeing. We don't necessarily have to buy bean acres. I'm not trying to make that argument, but I still think there's some moving parts to that final crop, final planted acre number as we roll forward.
Both of you make really good points. I just add in there, Nate, that the battle for acreage, I think you hit the nail on the head. We don't necessarily need to buy a lot of bean acres, but we certainly don't need to lose a lot more bean acres.
Right.
And perhaps,
True.
Perhaps that Nove bean Dees corn spread will notch it. It's narrowed back, or I should say firm back a little bit now. Maybe those beans are going to struggle, or they're going to try to keep that too many more acres from going to corn. I'll put it that way.
Yeah, especially if we see something develop, getting a little bit ahead of myself, but if we do see some weather, some additional weather flow into the corn market with the Brazil situation, it'll be hard for beans to sit, I think, on the sidelines. We saw a little unwinding of probably some pre-report positioning today, but overall, I think that's a great point. It's hard for us we don't necessarily need more bean acres, but we sure probably can't lose too many of them if we're going to rally the corn border, if there is any type of run in corn.
Yep.
Brian, let's jump into wheat then. A little bit more of a surprising acreage total on the wheat balance sheet. Why don't you break down by class what we saw?
We'll start out with the first estimate of spring wheat acreage, Nate. And you mentioned it earlier this winter, and it sure was spot on. The spring wheat acreage was down. HRS is down to 9.4 million acres. Last year was 10 million acres. So we're basically down about 6% from a year ago. And I think you guys did a terrific job earlier. Those acres are going in more into corn, maybe, you know, even a few acres, those beans holding their own ground. And spring wheat is kind of the odd man out, if you will. And that 9.4 million acres tightens up that balance sheet for 25, 26, potentially a little bit. I'm not saying we're running out by any means, but it's adds some element of yield impact there. Switching away from the winter wheat to our second, Nate, we did have a survey back in January that told us we were going to plant 6.44 million acres of soft red, and we only planted 6.09, 350,000 fewer soft red acres last fall. That has tightened up the balance sheet for 25, 26 on soft red. I defer to Michael, of course, on what the spread impact that may be, those type of things. But we certainly need a good yield now on this 25 SRW crop. It's not historically tight. Obviously, the exports are just routine unless China comes in. But the point is now, with that acreage basically unchanged now from a year ago, Nate, boy, that soft red, we need to get good crop. And now we're getting some flooding down there in some of the southeast and Midwest or mid-south, beg your pardon. Finally, wrap things up, Nate, on HRW. Just a smidgen smaller on HRW acreage compared to what it was in January. I don't see a lot of change there in the balance sheet. On the spreads, and again, I defer to you guys every time, but But I did see today Minneapolis and Chicago both gained significantly relative to Kansas City.
Yeah. Well, yeah. And I think the acres on soft red was fairly surprising just based on feedback we've gotten from clients, at least on the soft red side of things.
Given the fall we had.
Given the fall we had, all of it, right? And there are, to Brian's point, there are now, some areas that are receiving too much rain at not a great time for the production cycle. So it is something to pay attention to. But that was definitely a surprise just based on, people in the field. Other thing on spring wheat, this could be bad data, so I might need fact check, but I think it was the lowest. Is it the lowest since like 1970?
It's definitely one of the lowest ones. I have to go back and double check that,
but
I mean, but it's definitely the odd man out, if you will, on the planting side. Spring wheat.
Maybe put an asterisk by it, but that was I was scanning through data, and that was the best I could find.
Well, and you talk about, we've seen a decrease in wheat acres across space, right? That's been a natural occurrence, but we've held not at 10, 10.3, 10.5 on those spring wheat acres. Didn't get much lower than that, and maybe that is a little bit of that regional impact, right? As we see more corn acres, but also some of that soybean processing demand, where these producers out there are just looking at better returns, over spring wheat, and struggle to see some of the discount schedules. I'll put my farmer hat on. I think that's a pretty common occurrence that every elevator fights with. I bring my wheat in, and then I got 50, 70, $1 in discounts because of quality specs that. As we remain the residual supplier to the world on wheat, farmers just don't have to grow it as much. So we saw some positive reaction. I think spring wheat was up 12, 13 cents here. SRW was up 8 to 10, and HRW up a couple cents too. So not that you're shifting acres away from those winter acres that are already planted, but maybe some time to see some spring wheat acres adjust if we continue to rally a little bit, depending on then that relationship to beans and corn.
One other little tidbit there, Nate, and our viewers up in the Northern Plains are going to be buckling down here for the next week to 10 days with a big snowstorm coming through. And as you know, there have been years, if we were to build a snowpack, obviously there's nothing there of significance now, but into mid-April, it's supposed to be pretty chilly. And so that'd be another variable to watch moving into as we get into April, and of course, mid-May, it's time to plant spring wheat. And if we have some challenges there may be some switching eventually away from that 9.4 number down the road. Just food for thought there.
Yep. So kind of summarizing the acreage, Brian, when we look at our principal crop acres year over year, kind of compared to previous years, where did we fall into it? Are we going into this report, coming out of it saying, hey, we're low on overall acres, there's still some room for growth? Or are we kind of in a trend that we've seen with, I think, a little uptick in CRP acres and, overall plant intentions? We didn't have, while the economics favored corn, we weren't talking about prices that really incentivize, let's plant as many of these fringe acres or that variable ground. Let's not bring that into production necessarily. The returns weren't there. So where do we fall year over year?
Well, you hit the nail on the head, Nate. We're down 9.6 million acres principal crops compared to a year ago, and it's a 5-year low. So we're looking at, as you said, go back to that 2023 growing season. We were coming off of 2021, 2022 profitability, pretty much unprecedented across the ag commodity spectrum. And producers were excited. We had almost 320 million acres planted in 2023. Now we're under 310 this year.
Okay.
So really looking at basically the market telling producers we don't need those acres.
Yep.
And I think that until that changes, I think, as you said, perhaps more ground goes into CRP. We don't encourage those fringe acres to come back. And so I think that adds another bit of an ingredient into price volatility, if you will, moving forward into spring here. But no, there's no doubt that the market has sent a signal, just as it did 3 years ago. We need more acres. With the world production where it is today and world stocks, particularly beans, we don't need those acres right now.
Yeah, I'd say, honestly, barring any major spring weather issues that were to start to bring into the equation a lot of prevent plant or something, that it feels like we're pretty comfortable with the outlook today. Just taking everything into account, we don't really need to buy more bean acres, can't let them go down. Corn profitability was there. Producers like to grow it. We might see some price volatility here through the spring on the Brazil growing season and our balance sheet change, but right now it's you expect a little more volatility, I think, historically out of the planting intentions report. And for once we kind of came in the expectations within the range, and it kind of feels like that's a pretty good baseline to go forward here.
Yeah, it does.
So moving away from the acres, and the other part of today's report was the March 1 stocks. Corn stocks at 8.15 billion bushels, right around the average trade guess.
Yep.
Down from last year's 8.35. Michael, what did we see kind of from a regional breakdown in the on-farm versus on-farm versus off-farm, knowing the producers have priced a good chunk of their corn over the last couple months?
I think that's the key. Honestly, I would have, based on some of the things happening in the cash market and the basis landscape, I would have leaned a little bit lower than the average trade guess. Didn't expect it to be right on it, but we'll take that. I would have been shocked if it jumped really high, just based on some of the basis disparities out there right now, and some strength, especially in the eastern cash markets, creeping into Illinois a little bit, but pretty flat numbers, not a lot of excitement, which the corn stocks, even more so than acreage, because acreage can change based on price dynamics as we're working our way into the spring. I always think of this March quarterly report being driven. If you're going to see a huge move from a price standpoint, I think stocks usually swings the bat a little bit harder. Not a lot to take away from this. This is as close as I remember from a stock standpoint for like March 1 stocks. But to your point, we have seen, we have a different marketing cycle than last year. Sure, it was 8.35 last year. We're at 8.15 this year, 200 million less. It's, meaningful kind of. What really matters is the on-farm and commercial stocks, because that is quite a bit different than a year ago.
Right.
And it makes sense when you think about it. A lot of growers held on to corn pretty late in the marketing season last year, right? We saw a lot of corn getting sold, call it, June, but July, August, right towards the end. This year, it's been a lot different. We've front loaded the marketing cycle. A lot of farmers have sold at a more aggressive clip earlier in the year. So the percent of on-farm stocks is down across space. You really feel it in the Eastern Belt, but that also helps speak to why there's such strength in the cash markets in that space. Right.
Yeah. Seeing that Southeast pull.
Right.
But also something we've talked about this entire marketing year. I mean, the production down.
Yeah.
And, to your point of the producer holding those corn stocks specifically a little longer, that was very apparent in the Eastern Corn Belt, where they had a huge crop last year.
Yep.
So to see this shift now of not only do we have a smaller production in the Eastern Corn Belt, need to pull a little bit out of Illinois, and the price is kind of stabilizing here, it feels like it's going to be a little harder to get the remaining stocks out of those producers' hands in the Eastern Belt. And overall, I think just speaks to the tone of basis. We have had a big Western crop. There's a lot of commercial ownership in the West. But now we're getting into a stretch here where the producer focuses on planting, and probably basis and spreads might have to do a little bit of work. And we're seeing, we're seeing signs of that, and it's driven by that Eastern pull for sure.
Right.
Another thing from the stocks, just some of Dr. Schonkwaller's numbers here. We're accounting for this in our balance sheet already, but we did see an implied first half of the marketing year feed demand down year over year by nearly 182 million bushels. Yet the USDA's feed number for the remainder of the marketing year implies 160 million bushel more feed demand. So we're likely in April, I think, as we anticipated based on this stocks report, as we've anticipated based on some of the adjustments we've seen in the Milo balance sheets, et cetera, we likely see some reduction in the April WASDE for the domestic feed demand, and put that back into our carryout. So some additional, I think, confirmation from the stocks numbers, just based on what we've seen for feed and kind of the remainder of the marketing year going forward.
That's been needed for a while, right? And I think you're right. In April or May, that's finally going to get rectified. We might have just had to get over the hump of this report to do it, but you're right. From a Milo standpoint, from a wheat feeding standpoint, when it began to price here back in December, maybe January, higher inclusions of soybean meal, even higher proteins in feed rations. All of it was cutting into corn, but the USDA was reluctant to actually address it. On the flip side, we did get huge corn inspections today. So who knows what happens April 2nd when these tariffs are supposed to kick in. If we keep kicking the ball down the road, we have a pretty good cadence of demand here. And there's a chance, you could argue, maybe some of that feed attrition gets folded into exports if nothing changes and we continue the strength of the program that we've seen.
Right.
You know?
Right. Potential offset there to some of that.
Potentially, who knows, right?
Yeah.
But
Yeah. We'll see. Tariffs are probably what the market's going to focus on here again.
it
Very
feels like
shortly.
that. We're going right back to it.
Yeah.
And I still think back to something you said though in January, Nate. We may have already seen the lowest carry out of the year
Yeah.
a couple months ago.
Yeah.
And that's important to remember because markets are always looking at the direction of carry out, not only year to year, but month to month. And, we've stabilized, if you will, at a not a burdensome level, but not a super tight level. And the market obviously backtracked quite a bit from those February highs.
Yeah.
Yeah.
So
Yep.
it's just a lesson there that, make hay while the sun shines if you're a grower. And we had a big rally. And it's like Michael said, growers rewarded that market.
Yep.
Producers rewarded that market with January, February corn sales. And that's why that on-farm number is so much lower
Yep.
than a year ago.
Yeah. Still some variability in that too, as far as what we see with the Brazil crop and what that could mean to our Q4 export demand. But we'll shift back to kind of the monthly WASDs as we realize some of this, and obviously accounting for the planting pace and other things that we're seeing in the U.S. as we're navigating through the tariffs and the South American weather situation. Real quick on the bean stocks, Michael, any big outliers there? Kind of a similar situation, down year over year. I think tighter in the East, same kind of feel that we saw.
Bean stocks, yeah. I mean, I think we had bean stocks at 1.91 today, slightly higher than the average guess, but kind of right in the middle of the range. Honestly, the range was 1.82 to 2.01. Like it's smack dab in the middle. I think that probably overshadowed the acreage number to some degree, and that's why we saw beans down wherever they closed, 8, 9, 10 cents today.
I mistakenly said they were higher,
Yeah,
lower than last year. We were slightly above last year.
Slightly above, yeah, by 50 to 60 million above last year, but modestly above what the market was looking for. So it felt fairly well priced in. I think it goes back to what we talked about earlier. We have tremendous competition from South America. They have high stocks, plenty of supply. And we have ample supply to meet our domestic demand. So, we have to go into demand seeking mode to some degree. The market's comfortable, I guess, maybe is a better way to say it at the moment. And we got some confirmation of that today.
Seeing a little bit of the product values in the soybean crush equation come back in value a little bit as we've had some downtime. So, big picture, not a lot has changed in the beans. We're fighting a big South American crop. We're fighting the tariff rhetoric and what that could imply in our bean export picture, and trying to continue to feed the domestic demand growth, which is a lot hinges on policy with that. But for now, kind of comfortable picture as we go into the acreage or go into the planting window here. Yet we need to achieve the soybean acres, like we've said a couple times through this conversation. Not a lot of room for downtick in those.
Right.
Kind of wrap it up, any other thoughts on kind of volatility going into the growing season? Brian, what are we watching here now that this key report's behind us? Pretty much just focused to U.S. planting conditions and kind of Brazil weather.
Yeah, I think, excuse me, I would put reverse the order on that, Nate, and say Brazil weather.
Okay.
Next 30 days, critical time, month of April. We're going to be pollinating corn in Brazil. Right behind that, though, would be U.S. weather, because producers have shown a great affinity for planting early the last few years, and they've been rewarded. When you look at those bean yields the last few years, if it's going to be super wet and super cool here the next 2 weeks to 3 weeks, which is what some near-term forecasts are saying, that may build some type of volatility in that new crop picture. Those are the things we got to be watching, though. Brazilian weather, U.S. weather, and I think we do have to. Both you guys have alluded to it. We got to see what the impact of these tariffs, if they come through. Nobody knows. That's you just gotta let it play out. And from a producer standpoint, I really think you got to defend your balance sheet. Use those tools available to you.
I think we need a fairly warm, dry, uneventful growing season, I think, to hit this acreage number today. If like Brian said, those near-term forecasts that are indicating a little bit more moisture come to fruition, that it maybe is not a huge swing, but that could balance out that corn bean planting scheme a little bit.
Yeah, I kind of feel like it's welcome moisture today, but the extent of some of it, some of these heavy rainfalls in the east, we need to rejuvenate the soil moisture really pretty much across space. But if that starts to impact the planting, right, that's kind of our next what if scenario as we got the acre number and we're putting that behind us here for a minute. Any other closing thoughts for the producer? I think, Brian, you hit it. Just manage your balance sheet, protect your balance sheet, manage your price risk here. Likely volatility coming still as we go into, the normal pricing windows of spring planting and then U.S. growing season. It's a comfortable balance sheet today. We've got to prove it. So that doesn't mean by necessarily the lows are in by any means. We could still rally this board, but try to take advantage of that using optionality. Protect your new crop balance sheet, I think, is something we've talked about in every one of these conversations. So continue to manage that risk, and appreciate you joining us. Next report, April 10th, WASDE, and join ATI Pro Media at 9 a.m. every morning. Thank you.